we may have had one of the most pivotal FOMC meetings that we've had in a very long time. Hey everyone, it's Jonathan here. Let's go over some of the things that were said in the FOMC press conference that we had on Wednesday. As usual, the chair of the Fed, Jerome Powell, came out and spoke in the FOMC press conference, and he started off with his introductory statement. And he started off by saying that the Fed has covered a lot of ground when it comes to inflation, but there's still more work to do. He did discuss in detail the slowdown we are seeing in consumers. We're seeing less spending, we're seeing inflation start to come down as well. But he also did follow that up with saying that the labor market is still tight, but it has recently started slowing, as we've seen in many of the jobs reports. Then he also talks about how inflation has started to slow, but the FOMC feels that they need more data before they can really say that inflation is going in the right direction. And he also did mention how there's a concern that the longer high inflation stays, the more entrenched it becomes, and the more consumers start to believe that it will stay for a very long time. And he did say to anticipate ongoing increases will be appropriate. So that kind of implied that we'll probably see more than one increase in the future, which is very conflicting with what the market believes. Currently, the market is only priced in the Fed raising rates one more time in their March meeting, and then pausing from there. Now, Jay Powell did acknowledge the fact that a lot of the work that has been done by the FOMC does have a lagging effect, and it will take time for the market to feel the full effects of what the Fed has done. This was most of the reason why we only saw a 25 basis point hike. He also stated that the Fed does have to keep an aggressive stance against inflation to avoid premature loosening in financial conditions. It was a bit of a jab at the ideal that the market currently right now is pricing the Fed cutting rates by the end of the year. So now moving on to the Q&A session, Jay Powell was asked about the bullishness that we've seen in the markets over the past couple of weeks. And he said that the Fed's focus is more of tightening financial conditions in the long term and not just the short term. And then he went on to reiterate that the FOMC doesn't believe that they're at the appropriate restrictive levels just yet. And this honestly can mean two different things. This could mean that Jay Powell is even trying to talk down the markets by saying that, yes, we will go above 5%, even though you guys are not pricing it in, or that the market overreacted in December and is now starting to rebound from that overreaction. Then he was asked about how disinflation is starting to happen, even though there's very little change to unemployment rate. Jay Powell responded by saying that this is a good thing to see, but the deflationary process is still in the early innings. So we'll have to wait and see if this trend continues. And then he went into talking about how there's different parts of inflation. We have goods inflation, which we have started to see come down in the past couple of CPI reports. We also have housing inflation, which is still on the upwards trend, but is expected to come down, as we have seen from many different data centers that rents are starting to soften. Rent prices are starting to soften. And then services, which is still relatively high, but we do expect to see that start to come down as well. And Jay Powell did say how this is kind of what the FOMC was expecting to see. But one thing I will say that is very important is that labor data is a lagging indicator. So you do have to be cautious about that. Because usually by the time we start to see unemployment rates move up, we're usually already in a recession. That is just something good to keep in mind. Then he was asked about the Fed sticking with the terminal rate being over 5%, as they stated in the summary of economic projections from the December meeting. And Jay Powell kind of followed this question up by saying that the FOMC will issue a new SEP in March, that there's no discussion about where the terminal rates will be in the February meeting, but the FOMC will be taking a close look at the data between now and the March meeting and adjusting accordingly. But something that was interesting is he did kind of open up the possibility of the FOMC adjusting the terminal rate in March. So that is a really bullish sign. But he did also follow that up with cautioning that if they do start to loosen monetary policy too quickly, that could hurt, that could become a huge concern for the FOMC if we start to see inflation tick back up. So then he was asked about how the Fed's tone about policy changes is still the same, even though they have started to relax some of their concerns about inflation. So Jay Powell did follow this up by saying that the disinflationary process has started, like he said before, but he also did say that there is a need to keep financial conditions tight. So Jay Powell was asked from a New York Times reporter about possibly planning in a pause in between hikes. And honestly, in my opinion, this is a really stupid question because Jay Powell literally said at the end of his intro statement that the FOMC doesn't want to make the mistake of relaxing too quickly. So pretty much that's what he reiterated when he answered this question, but it's kind of like there's pretty much a zero chance of that happening. Whatever rate hikes we're going to get them all at once, and then once it's time to pause, it's going to be time to pause. Unless if we see inflation move up again, then the Fed will start to hike again. But there is some fairness to this question as well, because the bond market has been pricing in that possibility of the Fed doing a 25 basis point hike, pausing, then doing another 25 basis point hike. But in reality, that's probably not going to happen. So Jay Powell still believes that we could achieve a soft landing where we lower inflation without causing the unemployment rate to rise. And this is mostly due to what we are seeing currently with the data now. Now, when Jay Powell was asked about if the Fed was concerned about the market only pricing one more 25 basis point hike before pausing, Jay Powell pretty much doubled down on the fact that the FOMC does not plan to cut rates in 2023. He pretty much just stated that everyone's allowed to have their own forecast. The Fed has their forecast. Other economists have their forecast. And the Fed's forecast doesn't agree with the market's forecast. I think something that's very valuable to say is that the market expectations of inflation actually tend to have a heavy influence on inflation. Because think about it, if you believe that the price of your toilet paper is going to be a lot more in the future, then you're more likely to buy more now while it's at a lower price than to buy it later. So overall, this was a pretty bullish FOMC press conference. Jay Powell did state that the Fed is starting to see disinflation begin. And he did leave the door open for the possibility of less rate hikes than what was previously thought in the previous SEP, especially if we continue to see inflation come down. And he also still believes that it is possible for us to have a soft landing. Going into this press conference, I really thought that we were actually going to get a more bearish FOMC, but that didn't really happen. And if anything, we got a really bullish one. But at the end of the day, it all comes down to the inflation data that we get between now and the March meeting. So we're going to be paying close attention to the inflation data and the jobs data as well. So as always, thank you guys for watching. Please like, share, and subscribe, and I'll see you in the next one. Peace.